Hey, there's something in the tax code most real estate investors have never heard of. And today I'm going to be showing you the numbers. And I'm not just saying that to be dramatic. I'm saying it because I've been doing this for a long time. And I've sat across the table from thousands of investors. And when I bring this up, I consistently get the same reaction. And that is, wait, that's actually in the tax code? Well, guess what? It is. And if you've never looked at gas stations as an investment vehicle, today's video might change how you think about that, because the IRS, believe it or not, built something into the tax code that makes buying the right type of gas station one of the most powerful tax plays in real estate. And almost nobody is talking about it. Well, here's what I'm going to do. We're going to be going through exactly what it is, what the tax code actually says, and then I'm going to show you the numbers on a $2 million acquisition so you can see what this looks like in the real world. All right? Let's get started. Okay, so you already know how depreciation works, right? If you watch my other videos, I talk about this in those videos where we're talking about bonus depreciation, cost segregation. And so here's the thing, just for a recap. When you buy, let's say, commercial real estate asset, the IRS lets you recover the cost over time. Now, commercial is different than residential. So with commercial, you get to write off a little bit of that asset, right, over 39 years. Okay, that is what we call the recovery period. Now, that's a long time. And here's what that means practically. So if you buy a $2 million building, in fact, let's just look at this right here. So let's assume that here's the building that I purchased right here, and I buy this for $2 million. Now, as I said, you get to write this off over 39 years. So let's say you strip out the cost of the land, because you can never depreciate land. The only thing you get to depreciate is the structures on the land. So in this example, let's say the land here is worth $300K. So that leaves our total value here for depreciation purposes at $1.7 million. Now, what does that mean on a straight line depreciation basis, okay? So what it means is that you take 39 years, you divide it into 1.7, and that's going to net you approximately $43,000 in tax deductions or depreciation. Now, that's not exciting, right? It's not. I get it. But here's where it gets interesting. You see, the tax code has a special classification called a retail motor fuel outlet. And if your property qualifies, then the building, that is the structure itself, this thing right here, instead of writing that off under a 39-year depreciation schedule, get this, you get to do it in 15 years. Yeah, you just cut the recovery period in half. In that one change, by reclassifying that property from 39 years to 15 years, unlocks something huge. So let's actually talk about what qualifies, and then I'm going to walk you through the numbers on this. And I guarantee you, when you hear this for the first time, you're going to be blown away about what this can do for you. So what actually qualifies? Now, you can't go and find, hey, let's say I see this property right here. Here's this big retail outlet, and there's one pump outside of the retail outlet. That's not going to work here, okay? Every gas station, not every gas station is treated automatically the same. See, the IRS actually has a specific definition for what constitutes a gas station that's going to qualify as 15-year property. Now, what does that mean? Well, it comes down to this. There's a three-part test. You have to qualify under one of these three rules. So here's test number one. So the first test is what we're going to call the revenue test. And this one's really straightforward. In fact, most of these are. So with the revenue test, if more than 50% of the gross revenue that comes into your station, okay, comes from the sale of petroleum products like fuel. So if the pump revenue is the majority of what this location generates, then you clear this test, right? And you're considering, hey, this is an operating gas station, and they're not making their money primarily off the candy bars and the beer and the sodas and cigarettes that they sell. They're actually making it from petroleum products. Now, if it doesn't qualify under the first test, then you have a second test. And so test number two is what we call the floor space test. Okay. Now, what is the floor space test? Well, if more than 50% of your floor space is dedicated to, guess what, fuel or petroleum sales, Okay, so you think about the layout of a gas station. All right, so here's my gas station property, and I've got a big canopy here, and underneath that canopy are a bunch of pumps, and then I have a little store over here. Well, if the layout, if more than 50% of this is devoted to gas, petroleum, all right, the underground storage system, all that, okay, then because of that physical footprint, let's say we got storage over there, then you would satisfy this test, because all of this that I just showed you is more than the little convenience store that we have right here. So that's what we're looking at with the floor space test. Now, the third test that you have, if you need to qualify under, is what is called the square footage test, okay? Square foot test. And what you're going to do there is you're going to look at the convenience store building itself. So we look at this convenience store building that you have right here, and if the square feet, whatever, of this building, right, is 1,400 square feet or less, then you will satisfy step or test number 3. So if you're looking at a small, old school style gas station with a compact store, this is going to be your automatic qualifier, right? But the thing is, you have to meet at least one of these tests in order to automatically qualify. And most operating gas stations with a convenience store hit the revenue test. But your tax advisor needs to evaluate the specific property, and you're definitely going to want to document it, because if you ever get audited, you want the analysis in the file before you claim this deduction I'm about to share with you. Okay, so this is where the numbers start to stack up and where it gets really interesting. All right, so let me just show you what we're referring to. So we go back to this, the drawing board here. And so we buy that property for $2 million. Now assume that it met one of those 3 tests. So we acquire the gas station. Now, the $2 million gives us clean numbers, of course, to work with. So what we want to do here is, again, we have to take out the land. So I'm going to take the land off the table. So I'm going to take the land out of here, but take the $300K off. So that leaves us with a total amount, just like we did last time, of $1.7 million. So this is what we're going to depreciate, okay, on this thing. Now, the first thing we're going to do is we're going to do a cost segregation study. And this is where, you know, a specialized engineer is going to go through the property and reclassify the components from 39-year bucket into these shorter-lived buckets. Okay, normally when we talk about cost segregation studies, we have 5-year and 15-year on residential, 7 and 15-year on commercial. Now, at a gas station, there's going to be a lot to work with. In fact, we're going to have some personal property there. So we're going to get 5-year as well. So when you think about personal property, what am I talking about? Well, in a gas station, some of the 5-year property is going to be the equipment in the store itself, the cash registers, things of that nature. So let's assume that if we looked at the cash register, the refrigeration units, the equipment that wouldn't stay with the building if you were to move, and let's assume that all of that equals $425,000. So this is what we're going to do. We're going to classify $425,000 in 5-year property right here. Okay. Now what we need to do is look at land improvements, okay? So this is going to be 15-year property that we're going to look at. So what are we looking at there? We're going to look at the pump islands, right, where the gas pumps are. We're going to look at the canopy. We're going to look at the signage, the parking lot, the electrical, all that runs through this area, okay? That's another, let's say, I don't know, $340,000, okay? 15-year property. This is how a cost segregation study works. They look at all of this stuff and they start breaking it down. All right, so now we're getting up there. All right, we have just over $765,000. Okay, so here's a piece where it gets really interesting. This is what makes this type of real estate deal different from every other one out there. You see, the convenience store building itself, that structure, because we've qualified it as a retail motor fuel outlet, it goes into the 15-year bucket as well, not the 39-year bucket. All right, so that means it's eligible for bonus depreciation too. And let's say we stick that property at $765,000 right there. That is the C store, that's the convenience store. Now look where we're sitting with this overall investment we've made. all but $170,000 of this. Okay, that is the difference between all of these added up and the 1.7 million. There's about $170,000 left there that is going to be straight line 39-year property. Okay, so what is that going to equal? Well, 170,000 is going to get us about $4,359. $4,359 in depreciation. Now, what about this stuff down here? Well, that's where this all starts to add up, okay? Because all of this totals $1,534,000 and some change right there. Okay, so that right there on a $2 million purchase, that is your year one deduction. Now, why do I say it's a year one deduction? Okay, it's because you get to use bonus depreciation. So what you've done here with the gas station is just what you've done with your rental real estate or your commercial property. You've broken it down into 5, 7, and 15-year components with a cost seg study, and then you get to bring in bonus depreciation and you get to write it off all in year one. So what does that mean? Let's put you in a 37% tax bracket for a moment, okay? So if we're going back here, we have $1.5 million roughly. If you're in a 37% tax bracket, what does that translate into dollars actually back in your pocket? Okay, if you do that at 37%, that means dollars back into your pocket is going to be $567,000. That is a huge number. Now, when I look at that number, what it tells me is that that was my down payment in order to purchase this property. I'm getting all that money back. Compare that to what you would get without the right structure. With a standard 39-year, no bonus, no cost seg, right? The year one deduction that I showed you initially was only $43,000, something like that. Okay, look at the difference. Okay, this is the difference between working with people who understand the tax code and where the opportunities lie. Okay, that is a huge savings that's going to go back in your pocket, almost over $500,000. And hey guys, this is not a rounding error. This is a structural advantage that's built directly into the Internal Revenue Code that most investors never use because no one told them it existed. Okay, now, I know some of you watching this right now and you're thinking, I'm going to go out and find myself a gas station. And this is a great deduction, but I got to be straight with you as well, okay? We want to talk about transparency here as far as what this means to you, okay, on the back end, because I just showed you the good part about this, but most people don't understand what the back end is because no one's ever straight with them. They always talk about, hey, you can do cost segregation, you can do bonus depreciation. Okay, they always want to talk to you about the upside. Now, it's great to take that aggressive first year position on this, but when you go to sell, and that's why I want you to be aware of this, because I've talked to people over and over and say, hey, I'm going to go do this strategy, Clint. I'm going to claim my deduction, then I'm going to dump it because I don't want to run a gas station. Well, the problem is if you take that approach, the IRS is going to want their money back. So whenever you depreciate property, like I just showed you, when you go to sell, you have to recapture that depreciation. All right, that means it's going to be taxable to you. Okay, it's not a surprise. It's a known consequence of this strategy. So you want to plan for it. If you do, it's going to be manageable. So here's what I want you to understand. So when you go to sell a property that you've depreciated like this, there are essentially two buckets to think about. The first bucket that we look at over here when we go to sell, let me just put the two buckets here. This is the personal property bucket. I'm just going to put personal there, okay? And land improvements. And that's the 5 and 15-year stuff that we talked about, okay? That would normally would have been depreciated as Section 1245 property, but when you sell, the gain attributable to prior depreciation on those assets gets recaptured at ordinary income rates. So that means this big deduction that we brought in year one, well, when we go back to sell, all that gets recaptured at a flat 37%, okay? Now, the second bucket is for the building itself, okay, the 15-year retail motor fuel outlet. Because the building is Section 1250 property, then that's going to be captured at a flat 25%. So this one is ordinary income. And this one over here is a flat 25%. So this is going to be the building etc., is going to be taxed at a flat 25%. And the reason is because it's two different types of property. The building's considered 1250 property, and this one's considered 1245 property when you go to resell. So you're going to be paying taxes or recapturing that when you sell the property. So what do you do about it? Well, first, a few options. The most common tool for real estate investors, you probably know about this if you've been investing in real estate. The way we can avoid this is you do this. You do a 1031 exchange, right? You defer the recapture by rolling the proceeds into a new property. So you never pay tax. You keep the capital compounding for you, and then the estate planning tools can potentially step up your basis at death and eliminate the whole recapture entirely. That's why you see a lot of real estate investors say, well, I'm never going to pay tax on this because I'll just keep 1031 the property, and then when I pass away, I have a living trust. And then that living trust will take these assets that I've acquired through 1031 exchanges over time, and then they're going to go to my beneficiaries. And when they go to my beneficiaries, let's say that there's zero tax basis here. That means I've depreciated it down to nothing. Well, when my child gets it, if this building's worth $10 million at that point in time, in their hands, their tax basis is 10 mil. So they have a building that it's worth 10 million with a 10 mil tax basis. So if they were to sell it tomorrow, they would have zero capital gains. And so this is a strategy that's been employed by a lot of real estate investors, that I'm just going to hold on to the property. When it's time to sell, just do a 1031 exchange. Now, if you need cash, of course, out of the property, what do? You borrow the money out. So the point is this: even if you eventually pay recapture, remember, you had the use of that $500,000 in tax savings for years while you're holding the property. So if you're sitting here watching my video right now and you're thinking, well, Clint, this just sucks. Why would I do this? Take a tax deduction now if I sell in the future, right? And I have to recapture that money and pay taxes on it if I don't do a 1031 exchange. Because I'd rather have the deduction today and have use of that money right now and take that money and reinvest it and grow it. That's the mindset you need to understand why people want to do this. That is a huge financial advantage. It's just not a deferral on paper. Okay, two more quick additions before I wrap up. Okay, if you own this entity or own this property through a pass-through entity, an LLC or a partnership, and the gas station is treated as an operating business, you're also going to be able to layer on the qualified business income deduction, what we call QBI. I mean, this stuff just starts stacking up, guys, when you're running gas stations. So under current law, that's up to 20% deduction on your qualified business income from the operation side in and of itself. So for an active gas station with a convenience store, you have huge potential there with this QBI. So you get the deduction to buy it, and then going forwards as you're operating it, let's say I make $100,000 in income, well, you take off $20,000, you're only taxable on 80. That's a simple way of explaining how the QBI work. And then the equipment inside the gas stations, maybe you got to go out and buy some tangible personal property to upgrade it. That's Section 179 expensing, so you can write that off. Okay, and you can get that completely deducted right away. You see, these are all layers. Each one that you do adds something. And when you stack them on a qualifying gas station, the qualifying picture or the total picture is unlike anything that is available in real estate from a tax standpoint. So if you're thinking about making your next investment and you see a gas station out there for purchase, I would highly recommend you consider this, okay? As long as it has a qualifying and convenience store next to it, because that's where we're really going to start moving into these great tax benefits. I mean, 15-year classification on the building, bonus depreciation, cost segregation, QBI, Section 179 on the equipment. We're talking potentially about writing off 1.5, 1.7 of a $2 million acquisition in the first year. And the thing is, it's not a loophole. It's not aggressive. In fact, this is the tax code, and it's doing exactly what Congress intended. The problem is most investors never find out it exists until they've already bought the wrong asset. And I've been talking to a lot of high net worth professionals, high income earners now that are starting to look seriously at gas stations as a way to generate massive tax deductions for them. Now, this topic here of cost segregation and bonus depreciation and tax breaks. It's one of the topics we go really deep on our tax and asset protection event, because understanding this concept is one thing, but actually seeing how you structure it like I've been showing you and running it at the same time and making the right entity elections and planning around back-end recapture, that's where the magic comes in, and that's why structure implementation is so important. And that's what we're going to cover at our tax and asset protection workshops. Okay, if you've never been to our TAP event, I'm going to drop a link in the description below. It's a free one-day event. We teach them on Saturdays, and this is the kind of content that we get into because this is where the real money is for investors. It's not just finding good deals. And I've always said this, that entities and deals can help you do more if you understand where the wealth can be harnessed from the tax code. So if you found this useful, hit the subscribe button. I cover this kind of information regularly, and if you got questions, drop them in the comments. I read them, and guess what, guys? I'll see you on my next video.